We are diving straight into probably the most terrifying and definitely the most costly gap in your entire financial life.
Mhm.
It's this massive discrepancy between what your investments could return, the theoretical market gains.
And what you, the actual investor, actually end up with in your pocket.
Right. It's the ultimate self-sabotage.
It is. In the industry, we call it the behavior gap.
Yeah.
And for anyone listening who's already in the financial world, this number is going to be a shock. Investor behavior is the single most critical factor.
Okay.
We're talking up to 70% of long-term investment success or failure.
70%.
70. It isn't geopolitical risk. It's not what the Fed is doing, and it's definitely not that stock you picked back in 2018. It is fundamentally you.
That statistic is it changes the entire conversation. It's pulled from our sources, these deep industry insights, and it means all the time we spend agonizing over market timing, over valuations.
All of it. It's misdirected effort.
Yeah, if we haven't first neutralized the enemy within, which is our own psychology. So our mission today is to distill the core psychological barriers that are preventing you from building wealth.
And then introduce the single most powerful evidence-based strategy to counteract them. Automated finance.
Stop trying to time the market. Start focusing on maximizing your time in market. That's how you let compounding do its magic.
And we really need to unpack two core concepts to get there. First, why your ancient survival-optimized brain is, frankly, ill-equipped for modern finance.
Then second.
And second, how setting up just a few simple automated systems, we're talking a really small number of financial choices, can neutralize these psychological flaws and basically determine most of your long-term outcomes.
If you want more essential analysis like this in your feed, especially on these high-leverage topics, you should absolutely subscribe to Money Mindset.
Our deep dive today, it's based on a pretty robust stack of sources. We've got practical guides on financial automation, core academic theory on cognitive biases from Nobel laureates.
Including some pretty complex stuff like Bayesian game frameworks.
Right, and also deep industry data on these behavioral challenges. But the bottom line is this. Your future wealth isn't determined by market luck. It's determined by your ability to design a financial fortress that shields you from your own worst instincts.
Okay, let's unpack this using that foundational academic lens. Why is pure rationality just a myth in finance? When we talk about investor failure, we always have to start with Herbert Simon.
Yes, the theory of bounded rationality.
Right. But for an informed audience, let's go deeper. What are the actual constraints that Simon identified, and how do they show up in, a disastrous portfolio?
Well, Simon's theory completely refutes the traditional economic model that assumes humans are these purely rational optimizing machines.
The Homo economicus idea.
Exactly. He introduced the concept of bounded rationality because even today we face these severe cognitive constraints and computational limits. We just can't process the gigabytes of data flooding the market.
No way.
Or anticipate all the complex, often nonlinear outcomes of geopolitical events.
Yeah.
We have limits in knowledge, in attention, and just sheer computational capacity.
So we default to shortcuts.
Yeah.
We have to, right? Otherwise, we'd be paralyzed.
Exactly. We rely on simplified mental shortcuts, or heuristics. The problem is, these are the same shortcuts that were optimized like 150,000 years ago for immediate survival.
For avoiding the saber-toothed tiger.
Right, not for maximizing long-term shareholder value.
Oh.
And these heuristics often lead to systematically suboptimal financial choices. Think of it this way. Your brain is maybe 2 or 3% of your body weight.
Tiny.
But it consumes a hefty 20% of your daily energy. It is constantly looking for ways to conserve that energy.
That's the old, hungry, and impatient brain that behavioral finance experts talk about.
That's the one.
It's optimized for immediate survival, not for deferred gratification over a 40-year retirement horizon. And the result is that energy-saving snap judgment, like seeing a company's store with good lighting and thinking, I like the feel of this brand, so I'll buy the stock.
Bypassing any actual due diligence.
Completely. And that's a perfect illustration because that mechanism leads directly to the core problem identified by Daniel Kahneman, the difference between System 1 and System 2 thinking.
And this is so crucial because true wealth building demands System 2.
It does, and that's the whole challenge.
Over 95% of our decisions use the fast, automatic, emotional System 1 thinking. It's instinctual, it's effortless, but it's really prone to emotional hijacking.
And sound investment decisions.
They require the conscious, logical, analytical System 2. And system 2 is effortful. It burns that 20% energy budget.
So here's the connection then. When markets are calm, maybe we can activate Sister 2. We do our research, we calculate risk, we stay rational.
For a little while, yeah.
But the moment volatility spikes or you see your portfolio drop 5% in a week, your primitive System 1 just kicks in immediately. It bypasses logic and it's screaming, danger, flee.
That fight or flight response.
Yeah. And that response, which might have saved our ancestors from a predator, is what makes you sell off fundamentally sound investments right before the rebound, locking in your losses and just decimating your long-term wealth.
That constant tension between our instincts and sound financial practice is what we have to resolve. Because when we rely on those shortcuts, we fall victim to all these cognitive biases.
The predictable error.
The predictable errors. The fact is that behavioral biases reliably lead to poor investment decisions. It's almost a guarantee.
Let's start with the big one, the one that underpins almost every market panic, loss aversion. What does the empirical evidence from Kahneman and Tversky actually tell us about how loss works on our brain?
Loss aversion is really the bedrock of behavioral finance. It quantifies this psychological asymmetry in outcomes. The pain of a loss is felt about twice as intensely as the pleasure of an equivalent gain.
Twice as intensely.
Yeah, the typical empirical estimate is 2 to 1. And this isn't rational risk aversion, which would weigh probability and magnitude equally. This is a hardwired psychological flaw where any outcome below a reference point,
Like the price you paid for the stock.
or the peak market value, yeah, it just looms dramatically larger than any outcome above it.
That 2-to-1 ratio really explains the equity risk premium puzzle. If gains felt as good as losses felt bad, we'd all just pile into stocks, given their much higher historical returns.
Logically, we would.
But because the feeling of loss is so disproportionately painful, investors demand a much higher return than premium just to compensate for the emotional roller coaster of holding stocks, even for the long run.
Precisely. And loss aversion doesn't just make you uncomfortable, it fundamentally shifts your focus. You go from trying to maximize long-term gains to obsessively avoiding short-term losses.
And that's what drives the disposition effect.
That's exactly it. Investors hold on to their losing stocks for way too long in this desperate hope of just getting back to the break-even point to avoid realizing that painful loss.
And they do the opposite with their winners.
And they sell their winners way too fast to lock in the gain before it can possibly disappear.
The animal study that illustrates this is just, that's perfect. The capuchin monkeys and the apples.
It's so instructive because it shows this bias is deeper than rational thought. So these capuchin monkeys were trained to use tokens as currency.
Okay.
And they were offered 2 experimenters. Both of them, in the end, delivered 1 piece of apple. The payoff was the same.
Right.
But one experimenter would show 2 apple pieces at first, but always remove 1 before giving it to the monkey. So the transaction was framed as a loss.
Even though the outcome was identical.
Identical. The other experimenter just showed the 1 piece they were going to deliver from the start. And the monkeys strongly preferred the experimenter who only ever showed 1 piece. The fear of having something taken away, the loss frame, drove their behavior. It proves this bias is ancient.
So we're basically programmed to panic. Okay, now let's pivot to the opposite problem, the one driven by ego. Overconfidence. This is what pushes investors to trade way too much.
Yeah, overconfidence is this inflated, excessive belief in your own predictive abilities, usually after you've had a string of what you perceive as successful picks.
Right, you think you've cracked the code.
You do.
Yeah.
And our sources show this leads to a really costly pattern. Overconfident investors trade about 45% more frequently than their less confident counterparts.
45% more. Think about the impact of that.
It's huge. And that high frequency translates directly to significantly lower net returns. It's not just commissions, though those add up. It's transaction costs, taxes on short-term gains, and inevitably mistimed entry and exit points.
And this toxic cycle, it's constantly being fed by self-attribution bias, right?
Correct. Self-attribution bias is that internal story you tell yourself where you take full credit for your successes. That was pure skill.
I'm a genius.
But you blame external factors or bad luck for any failures. Oh, it was an unpredictable market crash, or the Fed ruined my play.
Right.
This self-serving pattern continuously feeds the illusion of knowledge, making you feel smarter than you actually are, which, in turn, reinforces the overconfidence, encouraging even more frequent detrimental trading. It's a closed loop, of ego-driven losses.
That's the person who says, I bought that stock because I saw the trend before anyone else, but when it tanks, they blame the macro environment.
Exactly.
And that inability to objectively look at your failures is what keeps you trading yourself into financial mediocrity.
Precisely. And while you're overtrading, you're also probably falling victim to the distortions of anchoring bias.
The tendency to rely too heavily on an initial, often completely irrelevant piece of information, the anchor. What's the most common anchor that locks people into bad decisions?
Oh, it's the price you initially paid for a stock. That is the classic anchor.
Right.
If you bought a high-growth tech stock at $100 and it drops to $50 because the fundamentals have genuinely changed, you might still anchor to that $100 price. You believe the stock is somehow fundamentally worth that amount, no matter what.
So the anchor distorts your sense of its actual current value.
Completely. And that leads to the irrational decision to just hold it indefinitely, waiting for this mythical return to your anchor point. Or worse, you buy more simply because it seems cheap relative to that old high watermark.
So if anchoring keeps us fixated on a past price, how does that mindset then set us up for the next bias, which is hindsight bias?
Well, anchoring often fuels hindsight bias, which is also known as the illusion of knowledge. This is the tendency to convince yourself after an event like a big market spike or a crash that you knew it was going to happen all along.
I knew it.
Yeah, you look at the rise of a major stock, you read the news stories, and you think, of course the signals were all there. I knew that stock was going to rise.
And the real cost there is this misplaced confidence. It creates a false sense of preparedness for the future.
Exactly. This illusion of knowledge leads investors to try and use past, unique, and often unpredictable events to predict future, equally unpredictable market cycles. It makes you believe you can consistently forecast the market.
Which is statistically impossible.
It is. The truth is, market cycles are unpredictable in both timing and direction. And hindsight bias prevents that crucial self-correction you need for long-term investing, which is just accepting true uncertainty.
And once we develop those false beliefs, either through overconfidence or hindsight, I guess confirmation bias really just locks us in for good.
Confirmation bias is the mechanism that keeps the whole flawed system intact. It means you actively seek out information that confirms your existing beliefs while you simultaneously ignore or downplay any contradictory data.
You create your own echo chamber.
A total echo chamber. If you are anchored to the idea that, say, the EV sector is due for a boom, you'll only read articles and listen to commentators who support that view. You get tunnel vision. You ignore critical warnings. You invest in subpar companies, or you miss superior opportunities in other sectors entirely.
It's the equivalent of only reading comments from people who agree with your political opinion.
Yeah.
It feels good, but it makes you profoundly ignorant of the full reality. So when you combine all these primitive flaws, loss, aversion, overconfidence, anchoring, you just realize the human brain is a terrible prediction machine for long-term finance.
That's the perfect summary. And that realization leads us right into Section 2, where we move from systemic cognitive errors to this temporal conflict. If Section 1 was about the mental shortcuts that trip us up.
Then Section 2 is about the battle between future you and now you.
Exactly. This is what academics call dynamic inconsistency.
And this psychological conflict, where our long-term goals just clash with our short-term actions, that's the root of undersaving and overspending, right? We all want a comfortable retirement, but we also want that new phone right now.
That is the classic definition. There was a survey in 1998, and 3/4 of respondents said they believe they should be saving more for retirement.
Sure, everyone believes that.
But the median shortfall between their aspirational savings rate and their actual savings rate was a staggering 13%. We have great intentions when we look forward, but our resolve just crumbles when the gratification is immediate.
It's like perpetually setting the alarm clock the night before. Future you promises to wake up early and exercise.
And then now you hits the snooze button the moment the alarm goes off.
Every time.
That is hyperbolic discounting in action. It defines this whole dynamic inconsistency using math. The key finding is that our discount rates are dramatically greater in the short run than they are in the long run.
Okay, so break that down.
Let's use the standard example. We might agree today that we prefer 2 apples tomorrow over 1 apple today. That shows long-term patience.
Right.
But when we bring that decision forward to right now, we prefer 1 apple right now over 2 apples tomorrow. Our short-term self radically discounts the future value of that larger payoff.
So the 2 apples are suddenly worth less than 1 apple now just because of the temporal proximity.
Yes. And the financial result of this is that chronic gap between what we should save and what we actually save. This is what drives high credit card borrowing, because that expense feels less painful than saving today. But here's the critical insight from our sources.
Okay.
This psychological weakness is exactly why illiquid assets like your retirement accounts become such powerful commitment devices.
So we intentionally make the money hard to access to protect ourselves from our own short-term urges.
Exactly. Consumers will willingly give up liquidity, even if there isn't a superior return, just to lock themselves into future welfare-enhancing actions. These illiquid assets, with their penalties for early withdrawal, they act as a forced commitment against our impatient short-run selves. They neutralize hyperbolic discounting by removing the immediate option for gratification.
That makes perfect sense. And speaking of short-termism combined with these primitive biases, let's go back to loss aversion and couple it with checking your portfolio too often.
Which gives us myopic loss aversion, or MLA.
Right.
Myopic loss aversion is the combination of that 2-to-1 pain of loss ratio with an overly short decision frame, the myopia. It's the tendency to check your long-term investments way too frequently, which makes you completely intolerant to short-term volatility and losses.
So the more you look, the worse you feel.
If you check a volatile growth portfolio daily, you are constantly exposing yourself to the negative side of that 2-to-1 ratio. It causes intense psychological distress and ultimately premature selling, which again just diminishes your long-term wealth.
The paradox is that the more diligent you think you're being by monitoring, the more likely you are to actually fail.
It's the financial equivalent of looking at your odometer every 5 seconds on a long road trip. You only see the tiny movements, you lose sight of the destination. And this isn't just an individual problem. MLA shapes the entire asset management industry.
How does it change how professional managers handle money?
Well, professional managers are keenly aware of their clients' MLA tendencies. If they underperform in the short term, those loss-averse, myopic investors will trigger massive fund outflows, which threatens the firm's stability.
Because they play it safe.
They're pressured to become closet indexers. They avoid taking high-conviction, potentially volatile positions that might cause short-term underperformance, even if those positions would maximize client wealth over 20 years, simply to avoid getting fired next quarter. The pressure to smooth out returns compromises true alpha generation across the industry.
And this all seems to trace back to a fundamental mistake in how the investment industry defines risk. They just equate volatility with danger.
That perspective is so misleading, especially for growth portfolios with long time horizons. For long-term goals, true risk is the potential for permanent capital loss or critically underperformance because your portfolio is just too conservative.
So volatility.
Volatility, which is just short-term price fluctuation, is primarily an emotional trigger used by your System 1 thinking.
But the volatility feels risky. It triggers that ancient fear response.
It absolutely does. But we have to look at the data. We examine sources that compare different asset classes over a 2-decade span, from 2004 to 2023.
Yeah.
Over those 20 years, the volatile S&P 500 generated a significantly higher annual compound return. It outperformed U.S. aggregate bonds by 6.0% and T-bills by 8.4%.
That is a staggering difference over 2 decades.
It is. Over that period, the S&P 500 generated nearly 5 times the wealth of T-bills and about 3.5 times the wealth of U.S. aggregate bonds. So despite being the most volatile option, it was the least risky in terms of failing to meet the long-term goal of wealth generation.
It's inescapable then.
The evidence is just clear. Compounding requires staying invested over long periods. If you believe stocks offer the highest expected long-term returns, the prudent approach is to maximize your stock exposure and just ignore the emotional trigger of volatility.
But that requires going against the grain, which brings us to the final major psychological challenge we face: the herd mentality.
Herd behavior is so deeply ingrained in our social and biological wiring. In primitive times, staying with the herd meant protection and survival.
Safety in numbers.
Right. If one member of the tribe instinctively fled, others followed. That was usually the optimal choice because the cost of being wrong was death. That instinct makes going against the consensus, like buying when others are panic selling, incredibly difficult today. We crave social validation.
So we're wired to fear embarrassment more than we fear financial loss.
Yeah.
This shows up as investors buying what everyone else is buying, jumping into the hottest stocks regardless of their valuation.
Exactly. And this fear, coupled with overconfidence, is why herd behavior amplifies volatility and creates these massive bubbles.
The dot-com frenzy.
Or the extreme volatility in the crypto market. It's driven entirely by FOMO, the fear of missing out.
And the environment today with these super accessible investing apps and this flood of financial noise on social media, it just creates a false sense of urgency.
A huge one. It pushes people to buy high during periods of euphoria and greed, often fueled by the belief that everyone else is making money, and then it compels them to sell low during panic and fear. That cycle is the absolute antithesis of long-term compounding.
The sources we looked at mentioned Bayesian game frameworks in relation to herding, which is a pretty technical concept. How does that modeling help explain the herd mentality?
Yeah, that's where the academic depth really comes in. In these game theory models, you have the herding investor, let's call them player 2. They rationally assume that other investors, player 1, might have superior information.
Okay.
So even if player two's own information is slightly contradictory to what the herd is doing, they conclude that following the herd is the safer, more rational choice to avoid major regret or perceived error.
So it's rational to be irrational.
In a way, yes. Even modest changes in the market's collective belief about the prevalence of overconfidence or risk aversion, among others, can cause massive shifts toward higher risk-taking. The result is a cascade of decisions that magnify an initial distortion, whether that was started by a genuinely informed investor or just an overconfident one.
The market becomes a feedback loop. Irrational behavior becomes perceived as rational validation. So we have an old, impatient, loss-averse brain that panics when things drop, buys when the crowd is shouting, and overtrades out of unwarranted confidence.
It sounds exhausting.
It sounds like an endless, self-defeating battle.
It is exhausting.
Yeah.
And it's why emotional intelligence is often a far greater determinant of financial success than raw IQ. We have to recognize that the average human investor is basically designed to fail at long-term investing. The crucial step is finding a way to permanently separate the human with all their flaws from the mechanical process of managing money.
Okay, so we've established that our greatest financial enemy is the person in the mirror constantly making these suboptimal decisions driven by ancient instincts. So now let's talk about the solution, the one that bypasses the ego and the emotions entirely.
The core argument here is that the key to overcoming these deep-seated behavioral biases is automation.
Plain and simple.
Because automation reduces the number of decisions vulnerable to human error.
It takes you out of the equation.
Precisely. Automation is the ultimate commitment device against hyperbolic discounting, and it's the ultimate shield against myopic loss aversion. Once you automate your financial life, you effectively move the decision-making process from your impulsive system 1 to a disciplined, tireless, and emotionless digital system.
And the goal is simple.
Spend less than an hour a month on money management, ensuring recurring bills are paid, and more importantly, that your long-term goals investing in savings are funded automatically.
I love this idea from the source material, the curve of doing more before doing less. We resist setting up automation because it feels complicated, but the argument is you front-load that work now to save exponentially more mental effort later.
You invest a few focused hours of effort up front, maybe a single Saturday afternoon, to set up the routing and the linkages. And the payoff is saving huge amounts of time, mental energy, and emotional capital over the long term. Your money flow becomes automatic, it's routed to the right places, neutralizing your innate tendency to spend it or micromanage it. You eliminate the emotional friction points entirely.
And the guiding principle while you're setting this all up should be the 85% solution.
Absolutely. Do not chase perfection. The desire to perfectly optimize the system is usually just a form of procrastination.
It is.
Trying to manage your money perfectly often leads to doing nothing at all, which is 0% success. Getting the system 85% right, just establishing the core flow and the commitment is exponentially better than sitting on the sidelines worrying about that last 15% of optimization.
Yeah.
You can always tweak it later. Starting is the critical act.
Let's break down the spending framework that makes this automation possible, the conscious spending plan. This framework dictates where every dollar goes and reinforces that idea that a small number of financial choices determine most long-term outcomes.
Right. If you get these core percentages right, you basically win the game.
So what are they?
We recommend 4 core categories based on your monthly take-home pay. First, fixed costs. You should target 50 to 60% of your take-home pay here. This has to cover your non-negotiables: rent, mortgage, utilities, insurance, minimum debt payments. If you're over 60%, the system is flagging a mandatory spending correction.
Okay, that's the foundation. What's next?
Second, investments. A minimum of 10% of your take-home pay. This is your future, your 401k, your Roth IRA, whatever. This is the amount that must be funded automatically every single month. That's how you ensure compounding requires staying invested over long periods.
Then savings.
Right. Third, savings goals, 5 to 10%. This is flexible. It covers short to medium-term targets like your emergency fund, a house down payment, a vacation buffer.
And the last one, which is my favorite.
The most important one, psychologically. Fourth, guilt-free spending money, 20 to 35%. This is your essential psychological buffer dining out, movies, clothes, hobbies, anything discretionary.
That guilt-free spending category is just psychologically brilliant. Why is setting aside money specifically for discretionary spending so important to the long-term success of the whole plan?
Because it manages the psychological pressure of consumption. We have a tendency to increase our spending as our income rises. It's a phenomenon called lifestyle inflation.
The silent wealth killer.
It is. If you don't define a hard limit on your discretionary spending, that spending will creep up and it eventually reduces the percentage of income that's being saved or invested. This structure protects your investment percentage first. It minimizes guilt later because you know the money in that 20-75% bucket is truly yours to enjoy. It's the mechanism that combats the fact that lifestyle inflation reduces the percentage of income saved.
Okay, let's move into the nuts and bolts, the three-step automation setup. This is the actionable takeaway listeners can use right now. Step one is just building the infrastructure, right? Linking the accounts.
Step one is connecting the plumbing. You need 5 key links.
Okay.
First, set up your paycheck to split. Part goes directly to your 401k. The rest is direct deposited into your primary checking account. Your checking account is your central inbox.
Right.
Second, link that checking account to your designated savings goal accounts and to your primary investment account, like a Roth IRA or brokerage. Third, and this is crucial, adopt a synchronized credit card strategy. Use 1 or 2 credit cards for almost all your monthly bills and spending.
For the points and protection.
Right. Then fourth, you link your checking account to pay off those credit card accounts in full automatically every month. This ensures you never pay interest, and it automates your main bill payment mechanism. And fifth, set up bill pay from checking for the things that absolutely need a bank draft, like your rent or mortgage.
That initial setup takes some time, but it's a one-time investment. Now, step two, which is often overlooked but prevents so many headaches, is the synchronization strategy, making sure everything happens on the right dates.
This is the key to achieving that set it and forget it status. If your utility bill is due on the 17th, your credit card on the 22nd, and your rent on the 1st, you have to constantly check your balance. You're opening the door for human error and anxiety.
So what's the fix?
It's remarkably simple. Gather all your recurring bills, call the companies, and ask them to switch your billing dates to align with the 1st of the month, or whenever you get paid. Most companies have an automated system to do this in under 5 minutes.
By aligning all the outflows, we can batch the process. So assuming our listener gets paid on the 1st of the month, let's walk through the exact transfer timeline to eliminate those emotional decision points.
Okay, so we treat the first few days of the month as the clearing process. On the 1st or 2nd of the month, your paycheck is split. The 401k funding is done. The rest is in your checking account, your inbox. On the 5th of the month, this is money allocation day. Automatic transfers go out before any bills are due. This is when the percentage for savings goals, that 5-10%, moves from checking to savings.
And investments.
Also on the 5th, the automatic transfer to your Roth IRA or investment account happens. This amount should be your total investment goal. That 10% minimum minus whatever already went into the 401k.
And there's a good tip for starting out here.
Yes. If you can't afford the full 10% yet, set up an automatic transfer for a minimal amount, even just $5. The goal is to prove to yourself that the system works. You have to cement the behavioral habit first. Automation reduces the number of decisions vulnerable to human error, and starting small proves the concept.
Okay, so savings and investments are funded by the 5th. What's next?
On the 7th of the month, the auto pay for all your monthly fixed costs and bills happens. And at the same time, the large automated transfer draws money from your checking account to pay off your credit card bill in full. Since all your bills were routed through the credit card and the statement arrived on the 1st, this 7th-day payment avoids late fees and interest entirely. It closes the loop.
So by the 7th of the month, your financial health for the entire month is secured. All your investments are funded, all your debts are paid, and whatever is left in checking is that pre-allocated, guilt-free spending money. The behavioral trap is neutralized.
It is. The money that's left is the only money you have available to spend guilt-free until the next payday. This system prevents you from ever dipping into your investment cash because it was moved out of reach within the first week.
That covers the traditional W-2 employee. But what about the large segment of our audience that deals with irregular income? Freelancers, business owners.
Irregular income requires a crucial pre-automation step. Building a stable buffer. You have to first figure out your bare bones income necessities: rent, utilities, food, minimum loan payments. Your initial savings goal, taking priority over investing, has to be building a buffer savings subaccount equal to 3 months of that bare bones income.
6 months, if possible.
6 is even better, and that buffer acts as the replacement for the stable paycheck.
So you're basically paying yourself.
Exactly. You temporarily direct any money you would have invested and use it to fund this buffer. In good months, 100% of your extra dollars go to the buffer. Once you hit that 3 to 6 month cushion, you can simulate a stable income by paying yourself a predictable monthly amount from the buffer, even during slow months. This decouples your volatile income from your fixed spending and automation schedule.
That sounds like a massive psychological relief. And for self-employed people, there's the added complexity of taxes.
Huge complexity. Since you're responsible for self-employment tax, which an employer normally handles, you have to conservatively set aside 40% of your income for federal, state, and local obligations. It's much better to be pleasantly surprised by a tax refund than stunned by a huge, unexpected bill.
And you automate this too.
You have to. Every time an invoice is paid and income hits your checking account, a separate automated transfer immediately moves that 40% into a separate, dedicated tax savings account. That money does not exist for consumption, period.
Fantastic. So step 3 is the easy part, but it requires that mental discipline we talked about. Sit back and enjoy, but monitor without micromanaging.
The system is now working automatically. Your money is flowing where it needs to go, meeting your long-term goals without your daily input. You should monitor the system, but don't micromanage it. We recommend checking in for under an hour a month. 30 minutes is usually enough. Use that time to review your statements, check your fixed cost percentage, and make sure the transfers all succeeded. And crucially, set up email notifications to review any unusually large bills before payment, just in case of an error or fraud. Otherwise, trust the system you built to neutralize your own behavioral flaws.
We've covered a tremendous amount of ground today, moving from the academic roots of our financial failure, Herbert Simon, Kahneman, and Tversky, Bayesian game theory, all the way to the technical steps to neutralize those failures with automation. Let's just quickly recap the key insight.
Your long-term wealth depends far less on predicting market cycles. Because let's be clear, market cycles are unpredictable in both timing and direction, and far more on just protecting yourself from your own evolutionary instincts.
Right.
The emotional pressure caused by behavioral biases like myopic loss aversion and herding is entirely overcome by implementing automated systems. Why? Because automation reduces the number of decisions vulnerable to human error.
So the ultimate actionable takeaway is this. You have to embrace the philosophy of time in the market, over-timing the market. Front-load the setup work now, those few hours of automation, to lock in the long-term compounding benefits that psychological resistance prevents most people from ever achieving.
And that automation is the behavioral shield that ensures your investment percentage is protected. It prevents that silent killer we talked about, the fact that lifestyle inflation reduces the percentage of income saved.
Exactly.
Because once the system is running, once your money is flowing automatically and you're hitting all your targets, the mechanical problem of money management is solved. The anxiety is gone, the self-sabotage is prevented, and that required 10% investment is guaranteed.
And once that 10% is guaranteed, and you realize that a small number of financial choices determine most long-term outcomes, the final, and I think most provocative question emerges. Now that you've automated your financial life and you are meeting your goals, what is your money for? Should you invest in travel or fitness or career development investing in yourself where the potential return on human capital is limitless? Should you increase your guilt-free spending money because the system can handle it? Or should you dedicate funds to philanthropy, one of the best returns available, whether it's your time or your money?
Now that the system is running itself, you have the bandwidth, you have the freedom, and you have the resources to define and live your rich life. That is the real end game that automation buys you.